All right, welcome to another episode of Weekly Market Update with Trading Terminal for Trading Terminal subscribers. We're recording this on Thursday, and oh man, what a day. All the indices are closing in green, as you can see from our Trading Terminal. On the week, energy was really strong, up almost 8%, healthcare, utilities, real estate, and the weakest sectors were really consumer discretionary, industrial. We had a few important economic data that came out that in this video we'll dissect them. The CPI came out, the PPI came out, and those are really important. We're gonna talk about them. And in terms of earnings, tomorrow we have the banks earnings. So Wells Fargo, as you can see my screen, Wells Fargo, BlackRock, Citi will all report their earning. And then next week you have some of the semiconductors, ASML, Tesla, Netflix, some of the tech names, as well as Goldman Sachs and more banks reporting on Monday. So Q1 earnings season is starting. Lots of exciting stuff. So let's go ahead to our agenda and dissect. So this is the agenda for today's video. We got money show announcements. We'll talk about the CPI numbers, what they were and what they mean. We'll talk about the PPI number, what PPI is and what it means. We'll talk about the market and earnings. And in this video, I want to talk about the credit cycle and how it works and how it impacts your full cycle investing. And then, of course, we're going to talk about the earnings a little bit. Before I go ahead and do that, I want to make a quick announcement. April 24th to April 26th, I'm going to be in Las Vegas. I'm actually presenting. I'm a speaker in Money Show. So if you're in the neighborhood, whether you're in California, Vegas, around the West Coast, I would love to see as many of you. A few of the other mods are coming as well. Brian's coming, Megan's coming, Mike's coming. We're going to do a meetup. And I'm doing 2 presentations. So I've been honored to be asked to actually present twice. This is the schedule. So on Monday, I'm talking about option trading for any market condition. I'll talk about how to read wicks and based on wicks, come up with the right trading strategy. And my master class is how to think like a hedge fund, a top-down analysis to run an effective long and short portfolio. So in this master class, I'll talk to you about key top-down framework. So looking at key indicators like ISM, like HMI, like PMIs, and using that information to actually make investing decision, a full cycle investing decision. The stuff that I'm talking about there is I have not talked about anywhere else. So this one is paid, but if you're on the fence, there's going to be 4 or 5 years of university amounts compact in 2 hours. It will be definitely worth your while. So I'll totally encourage you to come and join. Let's go ahead and talk about the CPI numbers. So the trend is very clear in the CPI numbers, consumer price index, that's your inflation. We had the high of 9.1, but then pretty much since November, it was pretty obvious that, okay, the core CPI and the overall CPI is actually coming down. But CPI is 2 categories. It's the core stuff, and then there is the services. And what Fed really cares about, the sticky part of the inflation, is actually the services part. So what's happening in the services? Are we seeing some relief in services as well? But when you're looking at the services sector of the CPI and inflation, you're actually not seeing that clear downtrend. We were at 7.2, 7.5. It actually went up. Now we're still at 7.3 year over year. So there is no clear trend that the services section of the inflation is coming down. So for that same reason, when the CPI number came out, the market actually sold off. And that was on Wednesday. Market actually came down about, not a lot, but about a 0.5 percentage point. Because the sticky part of the inflation is not coming down. And we're seeing it in our own business that we're running as well. A lot of our suppliers who are giving us services, they're jacking up their prices and they're not bringing it down. So we're definitely seeing it firsthand as a small business owner. So in terms of earning and where we are at earnings, there's a lot of talk. Earnings peaked in June of last year. This is for 2023 earnings. So NTM, it stands for next 12 months. So let me write it down, next 12 months. So next 12 months earning actually peaked at 250 and now currently sitting at 217. Once we see the Q1 results, I'm assuming this actually will go lower. My base case is somewhere around 200 actually. That's my base case for earnings season. Last year, it was at 196. So I'm basically betting 2022 to 2023, the earnings will remain flat. And then today, and again, I'll be recording this on Thursday, today the PPI number came out, and PPI is producer price index. So these are the input costs. So you can kind of imagine if the input costs are going up, it will show itself in CPI. So PPI usually leads CPI by about 1 to 2 months. And I have a graph that I will show you. But looking at PPI, you can see again, last year, June, last year, February, March, everything was super expensive. You can see this heat map was very, very red. Now that we're getting closer to March, almost every category has cooled down tremendously. So you see a lot of red here and a lot of blue. So prices are coming down, especially for the goods part. But again, on the services side, we're not seeing a lot of improvement. And this was the chart that I told you. The PPI usually, the CPI usually lags PPI by about 1 month, or PPI leads the CPI by about 1 month. So you can kind of see they move kind of hand in hand. The PPI has come down a lot, so that should translate into CPI coming down as well. So inflation is definitely coming down, but now the question is, why is inflation coming down so much? Is it in anticipation of recession, or no, it was just supply chain and all that issues, and things are actually resolving. In terms of Fed and Fed hike probability, right now the 25 basis point for March meeting, there's no more major economic events coming till May. So for the May 3rd event, the probability of a rate hike is sitting at 70%, and hold is at about 30%. If you ask me, however, I think we're most likely gonna hold next meeting, because we still have the bank earnings tomorrow, and next week the Fed's gonna actually take a look at the earnings and see how bad the situation is. I think more likely than not, they're gonna actually pause their interest rate hike. But at this point in time, I don't think it matters anymore for the market anyway. We all know that their terminal rate is going to be somewhere around the 5.25%, not much higher. And then this last section of the video, I usually try to do something educational for our viewers and our subscribers. And today I want to talk about the relationship between bank deposit, loan creation, and economic activity and earnings. So after the SVB happened and the collapse of the bank happened, as well as the rates going up, a lot of people are moving their deposit into money market funds, meaning they're buying, let's say, government insured security, security deposit, 6 months treasury bills, 1 year treasury bill. So how does that dynamic work? So, customers have deposit are liability, and they start moving that liability away. So we know from the accounting formula, you have assets should equal your liability plus equity. So when liability is going down, asset has to go down as well. So that puts a lot of pressure on the bank. The banks cannot create a lot of credit or loan generation. So when we see liability, aka the deposit, leaving the banks, that's going to put a lot of constraint on the banking system and remove liquidity. I often call it, imagine you're in a nightclub, the nightclub that is very, very busy. All of a sudden the fire alarm goes off and there's only one exit door. That's what's happening in the banking sector right now. So the data actually show that same story. So you have an 18% drop in total loan value, when compared month over month. So 18% drop in total loan value. So banks are lending a lot less. On a 3-month basis, again, you can see a massive drop, a loan availability compared to 3 months ago. So a lot less loans are actually available as well. And, on a bigger picture, when you look at the deposit of all commercial bank, which is the blue line, and then the credit creation, you can kind of see that both are following the same path and they're coming down. Why? Because as I mentioned, as the deposit leaves the bank, the banks cannot generate credit, which is loans. Their loan will go down, and that would lead into less growth. So it's kind of working that cycle together. It will be a lot less growth. So all eyes are going to be in earnings tomorrow and the next week. There's going to be definitely a lot of events. If you can make it and if you are around, definitely make sure to join me in Vegas and at the Money Show. Other than that, we'll see you next week for another weekly market recap. Thank you.